Hello, everyone. I'm Miles. The CAPM gives us a core conclusion. Only systematic risk truly yields returns because individual risks can be eliminated through diversification. Suppose investors can only invest in stocks and other risky assets. By creating different portfolios, investors can achieve the highest expected return for each level of risk. These optimal portfolios form a curve called the efficient frontier. But the portfolios on this curve still contain two types of risk: diversifiable risk or individual stock risk, and non-diversifiable risk or market risk. Therefore, this is not yet the final equilibrium state. Now, let's add a condition. Investors can freely borrow or lend money at the risk-free rate, such as through government bonds. A key change occurs. All optimal portfolios, that is, those with the highest return for a given level of risk, now fall in a straight line called the capital market line, CML. Any efficient portfolio is simply a weighted average of the risk-free asset in the market portfolio. The essence of investing is no longer about picking stocks, but about deciding how much market risk to take on. It's worth noting that the efficiency with which the market rewards each unit of risk, known as the Sharpe ratio, is equal to return divided by sigma, not just the absolute level of return. The portfolio with the highest Sharpe ratio is the market portfolio on the CML. At the same time, note that all portfolios on the CML move exactly in line with the market. There's no individual stock noise, no extra diversification returns, only price systematic risk remains, and they all share the same Sharpe ratio. Now let's work through a problem to understand this more deeply. Suppose the risk-free rate RF is 3%, portfolio A has an expected return of 9%, and a risk sigma of 12%. Portfolio B has an expected return of 11% and a risk sigma of 18%. Question 1. Which one is the market portfolio? A Sharpe ratio is 0.50 and B Sharpe ratio is 0.44. A is higher, so A is the market portfolio. Question 2. If the target risk is 18%, how do we construct portfolio P? According to the geometric relationship of the CML, W equals sigma P divided by sigma, which is 0.18 divided by 0.12, equaling 1.5. That means 150% is invested in the market portfolio, while 50% is borrowed from the risk-free asset. Also, beta P is sigma P divided by sigma, which is 1.5. Question 3. What is the expected return of portfolio P? According to the CAPM formula, ERP equals 12%. We didn't pick any new stocks, we just amplified our exposure to market risk. Finally, in a frictionless market where you can freely borrow and lend at the risk-free rate, the only decision left for investors is how much market risk are you willing to take? Because only non-diversifiable risk will be rewarded.